Hi everyone, it's Nancy Godrat. I am using this time to go over part of chapter 1 that is normally more complex. I trust that you already have read chapter 1. You know the terminology and the rules discussed in chapter 1. Those are not that difficult. Let's go over the basic accounting equation, which we will use for the rest of accounting 10 and the rest of your accounting life, actually. So, as you learned, assets in accounting means resources owned by the company. So, any resource that provides benefit today and future is called assets in accounting. Remember, accounting is a language, business language, so you're learning a lot of terminology and rules that you have to follow, same as learning any other language. You learn the vocabulary, you learn the grammar, and then with practice, you get fluent in it. And we have to do the same thing for accounting language. So example of assets are cash, supplies. And what is considered supplies? There is a difference between supplies and equipment. Supplies is considered pen, paper, toner for the copier. Those are considered supplies. Whereas equipment normally has a longer life. So when we put cars, trucks, printer, computer, any type of resource that the company purchases for the purpose of using in the company, and the useful life of that item is more than 1 year, we can put it under a different category. One of those categories is equipment. So I have provided you on Canvas, if I can go to that, under module 1, there is a very useful accounting terminology and their meaning, and also the hints for decoding accounting language to English that I would recommend you to please take a look at it. It will go over detail of the terminology and what you need to know about their definition. Okay, so going back to what we were discussing, now let's go over the definition of liabilities. Liabilities are any type of obligation that the company has, and let me see if I guess any type of obligation that the company has. So for example, if the company borrowed money from anyone, then that shows up under the category liability. Remember, assets, liabilities, and equity are large categories, and under each category there are subcategories, and under each subcategory there are examples, specific example. So assets is a category, and under assets there are 5 type of a subcategory, and the first subcategory is current assets that we learn about it in chapter 4, and some of the current assets is cash, supplies, inventory, accounts receivable, and so forth. So the assets of the company, basically the resources of the company, is either provided by the creditors, the people and entities that we owe money to, or provided by the owners of the company. And remember, in accounting 10 we're going to discuss a corporation's accounting. So therefore the owners of the corporation are called stockholders or shareholders. Both means the same thing. So stockholders' equity basically is the owner's claim on the assets of the company after all the liabilities have been paid off. So the assets that doesn't belong to the creditor belong to the owners. Now, stockholders' equity have 5 components. the 5 components is investment by the stockholder, which we call that common stock. Investment by stockholders, the other name we use is common stock, meaning whenever money comes into the business and it's coming from an owner, in exchange for that money, a piece of paper is given to the owner as evidence for their ownership. That piece of paper is called common stock. Every corporation has common stock, and a corporation can be owned by only one person, so that person could be 100% owner. So investment by stockholders or owners normally always increases stockholders' equity, what belongs to the owners. Revenues. The reason the company is in business is to generate more assets. By doing what? By doing either providing services or selling merchandise, by a type of business. You know, if they are landlord, by providing space for rent. If they are a bank, by loaning money and earning interest. So revenues result from business activities that are entered into for the purpose of earning money, income. So it's a result and effect. If you start providing services, you have revenue, and as a result of providing services and revenue, assets increase as well. Now, as I said, the stockholders' equity has 5 components. 2 of them, common stock and revenues, increase the stockholders' equity. 2 other components decrease the stockholders' equity. Dividends. What is dividend? Dividend is distribution of cash or other assets to stockholders for their personal use, so for their enjoyment. So the whole purpose of the owner starting the business or giving money to the business is eventually enjoying the fruit of the labor, enjoying the income of the company. And the companies, not all companies, some companies will distribute cash to the stockholders, and they call that dividends. Remember, dividends is not an expense. We're going to go over an expense. So since dividends reduces assets, therefore, what is left for the owners go down. That's why we say dividends decrease stockholders' equity. Now, expenses. As part of generating revenue, the cost of doing business is called an expense. Every revenue generation also costs the company money. For example, if I want to have an accounting firm to do taxes for people or prepare financial statements for them, financial reports, I need electricity, I need an office, I need supplies. As soon as I use the electricity, which belongs to another entity, I use resources to run my operation, my business has an expense. And I either have to pay it right away for that via cash, or owe the money and pay it later. Type of expenses are salaries. That's when employees work for us, and therefore, because of use of their resources, their labor, the business has an expense. So expense is generated as soon as the business uses a resource or consumes a resource, such as supplies. Rent is, using the service of the landlord, the space, and utilities, as I mentioned, PG&E and water. Those are become utilities expense, tax expense, what we have to pay to IRS. It reduces our assets and generates an expense of running the business. Now, the 5th item in the stockholders' equity, we're going to come across in Chapter 4 in more detail, and that's called retained earnings. Retained earnings. Basically, at the end of the year, you will see in Chapter 4 that we transfer revenue, expenses, and dividends to a different account called retained earnings. And retained earnings basically is the accumulation of the net income of the company minus dividends for prior years since the company has started doing business. Now let's go over this example, and we want to classify which part of the stockholders' equity these items belong to and what is the effect of them on the equity. For rent expense, well, it's an expense, the name is in it. It will reduce your stockholders' equity. Service revenue is when we provide services, therefore it's in the name it says it's revenue. It increases the stockholders' equity. Dividends, its name it says what it is, it's dividends, decreases the stockholders' equity. Salaries and wages expense is an expense and decreases the stockholders' equity. Now, what we're going to do with the rest of this chapter is to look at the economic events of the company, which we call them transactions, and analyze them and decide the effect of these transactions on the expanded accounting equation. And this is the expanded accounting equation. Assets equals, liabilities plus common stock plus retained earnings plus revenues minus expenses minus dividends. So remember, these signs are important. Why? Because we know common stock and revenue always increase the stockholders' equity. However, expenses and dividends decrease the stockholders' equity. And as I mentioned to you, retained earnings is basically the net income. What is net income? The difference between revenue and expenses is called net income. If revenues are larger, if expenses are larger, we call it net loss. And so at the end of the year, we transfer, like transferring money from your checking to your savings. This is the same concept. We transfer any money left in your revenue, expense, and dividends and to retained earnings. And then the next year, we start fresh, accumulating the information for revenue, expense, and dividends of that year in our accounts. So the next part of the chapter talks about the effect of each transaction on expanded accounting equation. Does it increase asset, decrease asset? So each transaction, you got to remember that it at least affects two items on the expanded accounting equation. And those items does not have to be on both sides. It could be on one side only, on the left side, which is assets, or the right side, which is liabilities and stockholders' equity. So not everything has to be affected, only two items. And the reason is that this equation has to always stay in balance after each transaction. So in this situation, we have a company that we're going to use in this book called SoftBite. And they started the business. So the owner gave $15,000 cash for ownership. Therefore, the company gave them common stock as an evidence of ownership. So in this case, the assets increases, but which asset? We have to be very specific. Which asset increases? Cash. And the stockholders' equity increases, but which part of the stockholders' equity is affected? Is it common stock or revenue? Because those are the two accounts that increases stockholders' equity. It's common stock because we haven't done any service or sold anything. So what I wanted to mention is that every time you look at a transaction, think about it as the effect of the transaction on the corporation and not the owners. You are the accountant for the corporation. What happens to the corporation cash or assets, liabilities? So I think I have time for one more transaction. This is when the company goes and buys equipment for cash, meaning our cash goes down by $7,000, but instead we get a new asset called equipment. This equation only affects the left